Concentration risks and lack of transparency are very real in banking. Last year, we had the Silicon Valley First Republic debacle, and this year we have embedded finance blowups with Evolve and Trust. So there's no doubt about the fact that it is a pivotal moment in banking, and the digitalization needs to advance to solve these problems. For this topic, I have with us today John Roberts, who is now the senior manager at Capstack and is joining us from North Carolina or Miami. Where are you, John, today?
I'm in Miami today, headed back to North Carolina this afternoon.
Yeah, excellent. And you have just joined Capstack from your company, Edge Tradeworks, right?
That's correct. We merged our companies. It's actually an interesting conversation. I had met Mahal Kapelinski. We were having a conversation. I gave him a demonstration of our product. This was on a Thursday or a Wednesday. He sent an email immediately. We have to have a call on Thursday. We were 5 minutes into the conversation, and he goes, this ought to be actually a different conversation, shouldn't it? And I said, yes. I said, you have what we don't have, and we have what you don't have. If we glue the two firms together, we actually have the chance to completely change the financial landscape in the United States. So we started on the journey, and we were acquired by Capstack on June the 14th.
That is love at first sight.
Yes, it was.
Right, two fintechs, and Edge Tradeworks is what, 10 years old?
Yes, we're probably about eight years old now. It was sort of an idea that my co-founder came to me with, and he goes, what do you think about building a trading platform for whole loans? I'm like, why would we do that? And he said, have you looked at how they're traded? And I said, not really. I started looking, and I couldn't believe it. I thought I was missing something. It was like something out of the 1970s. People exchange Excel spreadsheets. Typically, a broker-dealer is involved. The broker-dealer will look at a loan or a list of loans and go back to the seller and say, okay, we're gonna pay you 98 cents on the dollar for those and charge you 1.5 or 2 points in a transaction fee. At the same time, they're telling the seller that they'll pay them 98 cents on the dollar. They're out trying to market the loans to the rest of their client base at 101 cents on the dollar. So in essence, they're making roughly a 3-point bid offer spread and charging anywhere from, in reality, 1% to 3% in a transaction fee. And everyone's in the dark. It's an opaque process. The buyer and seller are masked from one another. No one has access to analytics. And the broker-dealer provides basic analytics and some basic sort of, negotiation. But the process often takes 3 months to execute a transaction. So we started to build the platform. And as we did it, people saw it and said, wow, this doesn't exist. It'll be a home run if you can make it work. And we started down that road, and it ended with meeting Mahal.
Amazing. So we're talking about an over-the-counter market that is really operating in the dark ages, right?
That's exactly right.
It's not about disintermediation and improving, reducing fees and so on. It's really starting from scratch. And why do you think that this was the state of the whole loan market, and why is it the moment now to really move forward?
There are a few reasons, Effie. Number one, it was the state of the market because your typical broker dealer has been very involved in the fixed income markets, the bond markets, and over the last 15 years, the spreads available in those markets have collapsed considerably. The only market left that they have that has large spreads has been the whole loan market, and they've been fighting very hard to keep that market in the dark so they can continue to make their wide spreads. On the flip side of the equation, if you look at the banking industry, it was a little late to the start in using technology. The regulators have also been late to the game in technology and are often baffled by banks that do use technology. There's some brave CEOs out there that have actually said to the regulators and said to them, hey, we don't know how to regulate you. You can't do this. And the CEO's response has been, no, the fact that you don't know how to regulate it is your problem. We're going to keep doing this because if we're going to be in the banking industry and be successful, we have got to use technology and we've got to become more efficient. So with the use of our platform with Capstack, it actually allows banks to access liquidity in their loan portfolios that they typically have not had access to. Historically, many banks have hedged their risk by trading in the securities markets. And instead, now they have the actual opportunity to trade the assets that they're actually trying to hedge and create a more balanced portfolio in the process of doing so.
So if I understand that correctly, this is not about origination of loans. This is the secondary market trading and managing risk of existing loans, right?
Well, actually, it's for both, Effie. If you look at the banking industry, on the origination side, some banks are very good at originating particular types of loans, whether they're commercial real estate loans or commercial and industrial loans or mortgage loans or auto loans. But let's say you're a commercial real estate originator and you're very good at it. You may get to a point where you are at your upper guideline using FDIC regulations of 300% of total capital in commercial real estate. If you get there, you basically have two choices: stop originating or find a way to sell or participate out the risk that you're accumulating. So you can actually say, here comes a new client, he wants a $100 million loan. You can say, give me a couple of days, and you're willing to keep 10 million of it, but you find other participants that come in with you, and it's like a mini syndication. You can participate out, say 90 million of that. So you're only acquiring 10 million of the risk, but you still maintain the client relationship, and you're still in control of the entire loan, and you just parse out the principal and interest payments as they come in on a monthly basis. So that would be part of helping banks continue to originate. But we also, and that's the participation, we also trade loans where the bank actually sells the loan. So it works both ways like that.
So it's also unlocking value or facilitating, making more efficient the participation in loans, that process too.
Absolutely.
And when I think of this market, how would you compare it to the digitalization in the mortgage market?
So the digitalization of the mortgage market has been a very interesting process. If you go back 20 years, banks controlled about 90% of the mortgage market. Today, banks control roughly about 35% of the mortgage market, and third-party originators, Fintech, have really kicked banks out of the space and represent 65 to 70% of the entire mortgage market because they're efficient. And it really boils down to, what does it cost you to originate a loan? The average cost to originate a mortgage loan, I believe last year in the country, was around $13,000 or $14,000, but averages don't tell you the story. Some banks spend $24,000, $25,000 to originate a mortgage loan. Well, if you originated a $250,000 loan and it cost you $25,000 to originate it, you should not be in the business of originating mortgage loans. You should go buy it because they're much lower. There are many lower cost producers. The average Fintech originator probably costs them between $1,500 and $2,000 to originate that loan. So from your perspective, if you want that exposure, you should actually buy that loan rather than originate it.
So the wholesale loan market is well behind the mortgage market in terms of digitalization.
Yes, and the reality of it is every loan originated is a bespoke piece of paper. And those pieces of paper can trade, but if you think about it, in today's world, you could digitize all of that, and there are a few firms that are starting to do that. If all loans were digitized, it would make the entire process much more efficient, and it would eliminate fraud. It would eliminate all kinds of errors. So I think we'll eventually get there, but it'll probably take another 10 years.
Yeah, I mean, you reminded me, John, back in the subprime crisis during 2008, when there were people looking to find the note of the mortgage.
Yes.
Because, they couldn't find it. It was lost, right? And the banks didn't know in which securitized pool the mortgage was. Just a nightmare.
But if it were digitized, you'd be using blockchain. So there's a permanent record of every single thing that cannot be changed. So unless the network agrees to change. So we'll get there eventually. But in the meantime, Capstack is helping the industry take a step in the right direction and making it much more efficient by leaps and bounds.
So this addresses the concentration risks that bank loan portfolios, their loan portfolios has, and it's also helping the systemic risk.
Yes, because you can prove to the regulator, for example, that you actually have liquidity in your underlying loan portfolio. But if you go a step further as the trading volume increases, we can anonymize the data and give that to the regulators, and they will know where particular types of assets actually trade. They can back into a pricing based on the spread on where things trade, and it can give them comfort or concern around a given bank where that bank in particular has their assets marked.
So the vision is not only to have this trading platform, it's not just a marketplace. What else is there that will make this magic happen or unlock this value?
Underlying our marketplace, we have a tremendous suite of bank analytics. And the assumption when we started was that a bank may run into another bank that they don't know anything about. Well, you don't want to trade with someone that if you don't know anything about them. So you can instantly pull up a particular counterparty and you can look at their credit profile. You can see what their loan losses look like, what their non-performing loans look like, and gain comfort that, hey, this guy's a really good originator. He has very low loan loss reserves, very low non-performing loans, but he's someone that we think is potentially a very good underwriter, and we could buy loans from him and feel comfortable about it. On the other side of the fence, we have a tremendous suite of analytics around loans. We can price and risk any type of loan you would find on a bank balance sheet. We can do all kinds of scenario analysis, which is typical of banks when they buy loans or are trying to analyze their own portfolio. And you can change prepay variables, you can change default variables, recovery variables, you can change the spreads, you can do all kinds of scenario analysis on the platform, and it will do everything for you. Or if you want, you can really get down in the weeds and get at a microscopic level, changing very small details and see what the impact on the market value of your portfolio of loans is.
In terms of the impact on banks, where do you see the biggest benefit is going to be? Is it for mid-sized banks? Where is really the biggest bang for the buck?
Well, Effie, if you look at the U.S. banking industry, there are roughly 4,500 banks in the U.S. and there are roughly 4,500 credit unions in the U.S. But if we just talk about the banking world for a minute, the banks 50 billion and under is probably going to be our sweet spot. I would say the larger banks will end up using the platform to acquire assets because they typically are deposit rich and need assets on their balance sheet. So I think the primary client base would be the community bank and the banks that are regional banks, but the very large money center banks have the technology and have the ability to do a fair amount of what we can do. But that means there are roughly 4,000 clients that are a perfect fit for us.
And in terms of all this data, what is the biggest challenge or the roadmap? Is it the analytics? Is it the data, the onboarding? Give us a sense of where we're at. What are the opportunities and the challenges?
Sure. So we have a tremendous amount of data in our system that's constantly updated. And most banks find it very difficult to acquire that data and to also manage that data in a useful fashion. So, for example, I can create a custom peer analysis in about 30 seconds that would typically take a $20 billion bank 6 hours to create. So if the CFO or the CEO is looking to acquire a bank in, let's say, Alabama, he can go in, look for banks in Alabama, look for banks that have a low loan to deposit ratio and high securities, which means they've got a lot of liquidity and potentially can't make loans. That's a perfect target for them. And they can go in and start having a conversation. At the same time, banks can look for potential partners to participate loans to or to buy and sell loans with in the same fashion and reach out through the platform and find those counterparties.
John, you mentioned how Edge Tradeworks started. Tell us a little bit about your journey, your personal journey in financial services. How did that start? And then you found yourself in the niche B2B wholesale market.
Exactly. Well, I originally started as a mechanical engineer, but went back and got my MBA and then went to New York and went to work for the old JP Morgan. And that was a long time ago, but I spent 12 or 14 years with JP Morgan building, scaling, and running fixed income businesses, trading businesses in New York, London, and Tokyo. and was always at the forefront of using technology in the markets. I was the first trader on the government bond floor at JP Morgan to use a computer. And when I started doing that, everyone laughed at me. And 6 months later, everyone wanted a computer. We were actually doing algorithmic trading in 1990 when no one had ever heard of it. And when you fast forward, technology continued to advance, and platforms started to evolve that removed the loan brokers, and that was digital and that was electronic. And then the TradeWeb was one of the first platforms in the U.S. Treasury market, and it allowed clients to query dealers for pricing electronically rather than having to pick up the phone and call. And we were at the forefront of technology using TradeWeb. The day we joined, we became number 3, and we rose to number 1 within 2 years and stayed there the entire time that I was involved with the process. So I've always been involved with technology, and bonds and loans are fixed income in reality. And they're very similar, and many loans are actually bought and securitized, and they create securities out of them. And that was the light bulb that went off in my head. Hey, Wall Street spends hundreds of, millions of dollars on an annual basis pricing these securitized products, which underlying are comprised of loans. Why can't we just price the underlying loans? And that was the beginning of our journey to build a trading platform.
Yeah, I mean, it's really moving assets that are not tradable and making them tradable. And technology is ideal for that. The data analytics, building platforms, and so on.
Our intent is to put the two counterparties together and let them negotiate directly with one another. So on our platform, the buyer and the seller negotiate directly with one another in secure data room. The entire exploration process takes place on the platform. The entire due diligence process takes place on the platform. And as a result, a trade that may have historically taken 3 months can take as little as a day, but often takes a week or two to transact by the time the credit officers have reviewed all the credit files and everything. And there's a permanent record of everything in one spot. So if the auditors or the regulators show up in a year's time and say, what were you doing when you did this transaction? All they do is go to that order number on the platform, and all the negotiation, all of the files, all the analysis that they ran on the loan pool is right there in one spot, that they're not chasing emails or wondering who talked to who on the telephone.
Give us a sense of the size of this market and the differences and the challenges.
Well, it's hard to find data on everything, but very, very conservatively, I can come up with numbers that are $1.5 trillion, but the market is easily a $3 trillion market. So it's a tremendous market, and it is ripe to be sort of computerized or to use a platform like this. And the real beauty of it is, if the trade doesn't suit the buyer and seller on the platform, the trade doesn't take place. But if they've gone through the negotiation, they've discovered a lot about the loans, a lot about each other. There's been a price discovery between the buyer and the seller with no one masking anything. Sure. All right. On our platform, if the buyer and seller aren't comfortable and can't come to an agreement, the trade doesn't take place. There's no middleman trying to force a trade, because it's the broker's benefit to execute a trade every time. They get paid, and they get paid a lot. Our goal is for our counterparties to find deals that suit both of them. So if the trade doesn't make sense, the trade doesn't take place. And the way the process works today, it's a long, drawn-out process, and they get into the due diligence process, and they start going through all of the detail, and they start throwing loans out because they don't actually fit what the buyer is looking for. On our platform, the buyer's already explored everything. They understand everything they're looking at, every loan they're looking at. They've already got all the details on it. So the due diligence process becomes a confirmation process and not an exploration process. Okay. So it's a complete game changer, and we reduce the time for a transaction from months to a few days or a week or two. It's a tremendous increase in efficiency and safety perspective, because they're actually a whole lot smarter about the loans that they're buying.
100%. And we know that operational liquidity is often behind many crises. So here, if you don't have to wait 3 months to resolve an issue, this is major in terms of risk management and operational.
Well, Effie, you just hit on a really important term, operational efficiency. And if you look at how many loan participations take place today, they're on Excel spreadsheets. So if I participated out, say 40% of a $100 million loan to you, and every month I've got an Excel spreadsheet, I know I need to make some P&I payments to you, and that's easy if it's one loan trade, if one loan participation. But if you get to 100 participations, you've got spreadsheets everywhere. You've got people in the back office pulling their hair out. Where are we supposed to send all this money? You're trying to keep track of all the updated financials of everything. On our platform, we can actually handle all of the cash flows for you. We can keep track of the participation cash flows. So it allows you to just keep on participating to an infinite level, because it doesn't matter. The machine will do everything for you and do it correctly and with a permanent record of everything. And it allows the back office. We have a completely separate chat function for the back office. So your back office can talk to my back office, track all the data, track all the principal and interest payments, track any financial updates on the client. Everything's right there for the banks.
As I'm listening to you, I can imagine how many band-aids exist within each back office of a bank to try and deal with these spreadsheets and the timing of cash flows and the covenants and everything.
Well, you're so right. And the spreadsheets are just a thing of the past. And the reality of it is we'll be able to pull data from a native connection, so we can connect to a bank's core processor or loan origination system and pull the data in directly, which means the data is correct. It eliminates a huge amount of inefficient emails and spreadsheets and Google Drives and everything else. It eliminates all of that, but it also eliminates errors. It takes the error rate much lower.
Amazing. I mean, I'm hearing that fintech is really ready to hit the whole loan market, and it's long due.
Well, if you think about it, though, the fintech is a term that's misused. There are so many people out there that claim they're using AI, that claim they're using fintech. We truly have real technology that helps you manage the data, helps you manage your risk in a very efficient and easy to understand fashion.
I mean, I totally agree with you. I was discussing with a colleague of mine that maybe we should retire the fintech term these days, right? We don't need to distinguish who's fintech, who's not, who knows anymore, who merits or whether there's any value to that title. We're talking about, do you have a business? Do you have a platform that is really genuinely data driven and offers value and efficiencies and allows the end customer, in this case, we're talking about B2B, to manage their business better and hopefully create also new business revenues.
You're exactly right. And you hit on a point there. And in fact, we want to end up becoming part of the infrastructure of how the financial system actually operates. And it will be much more efficient as we progress and as they progress with us.
So give me an outline of the vision. Is this becoming part of the pipelines between the banks, part of core banking systems? What are you envisioning?
Yes, we basically become a pipeline between the banks, between the regulators, between the bank's data, and it becomes much more efficient. And as it grows, it gets more efficient, and it generates liquidity and transparency in the banking system. And I can't imagine that anyone would argue that liquidity and transparency are a bad thing. In fact, liquidity and transparency are what have been lacking for years in the banking industry, and we bring that.
And really, if we were to reinvent the new fintech term, that should be it: transparency, and as a result, liquidity and better risk management, because that's what financial services are all about, undoubtedly, and that is never, ever going to change.
You're correct. It is about liquidity and transparency. The banking industry has lacked that, and we're going to bring it. And as a result, as the efficiency takes hold, it actually is good for the consumer. It's good for the borrower because the borrower is able to get a lower rate.
100%. The risk premium should go down.
Yes.
And the possibilities of systemic risks because of these concentration risks, because of the lack of transparency. I mean, again, I will never forget during the subprime crisis, everybody was running around because they couldn't even measure their risk. It took them weeks to know what their risk was because, of course, gathering the data and measuring risks was a tedious process. I mean, these days, that should be very different. We're not yet there.
Well, we're a tool that allows that. So we're very optimistic and very encouraged by the response we're getting from the banks and from the asset managers. And I think we're onto something here.
Great. John.
I know we're onto something here.
You have the confidence of Southerners, I must say. You are a genuine Southerner, and so am I in Europe, right?
Yes.
And we're both very enthusiastic about really deploying technology to manage risks, because at the end of the day, that is what financial services are all about. And it's not just the user experience in the retail industry that we have to improve. We really have to go in where the pipes are and where the real difficulties are and the challenges.
And technology has completely changed the restaurant industry. And it changes all these industries, and the banking industry has been slow to adapt. But it used to be if you wanted takeout, you had to pick up the phone, you called somebody, you put an order in, you gave them a credit card number over the telephone, you waited 20 minutes, you got in your car, you drove somewhere, you picked up your dinner, then you drove home, and then you had to reheat it. Today, you go online or you go on your phone, boom, boom, you order your food, and 20 minutes later, it shows up at your door and it's hot.
And it's the same type of service, and it's the same type of efficiencies that we want in the banking system. John,
Indeed.
Thank you so much for joining us today and giving us all these explanations about the challenges and the opportunities and the mission that Capstack is on.
Well, thank you very much, Effie. We're always happy to answer questions or show people how we work. We think anyone that sees it is going to be very impressed and say, wow, why isn't every bank in the country already signed up?
Thank you.